Hello everyone and welcome back to Muffet Investment Views. Today, we're diving deep into the US government's debt situation. We'll explore the intricacies of the government's spending plans and liabilities, the growing interest payments on the debt, and what might happen if interest rates rise. We'll also speculate on the potential devaluation of the dollar as a means to reduce the government debt. Let's get started. The US national debt is a critical issue that affects every American. As of 2023, the national debt stands at a staggering $34 trillion, with total liabilities, including federal employee and veteran benefits, reaching $42.9 trillion. This unsustainable fiscal path poses significant challenges for the country's economic future. To understand how we got here, we need to look at the government's spending plans and liabilities. The U.S. government's gross costs in 2023 were $6.13 trillion, while revenues from taxes and other sources were $4.4 trillion. This resulted in a net operating cost of $1.7 trillion, contributing to the increasing budget deficit. The debt-to-GDP ratio could reach 531% by 2098 if current policies remain unchanged. This unsustainable trajectory underscores the urgent need for fiscal reforms to ensure economic stability. The government's primary areas of spending include Social Security, Medicare, defense, and various entitlement programs. Social Security and Medicare alone are projected to exceed revenues by $78.4 trillion over the next 75 years. This long-term imbalance between spending and revenues highlights the need for significant fiscal reforms. One of the most pressing concerns is the interest payments on the national debt. The interest payments have touched $1 trillion this year. Net interest payment now constitutes 13% of government spending, above defense at 12% and just below health at 14%. This rise both due to rising debt levels but also due to increase in the interest that the government pays on the debt. After the 2008 financial crisis, the Federal Reserve embarked on the QE program to stimulate the economy. It continued to buy government bonds for nearly 10 years. This pushed the bond prices up, and so the interest rate that these bonds yield fell. It is important to note that bond prices and yields have an inverse relationship. So if the bond prices fall, then the yields will rise. As you can see from the chart, as the Fed started the QE program, the yields fell and reduced the cost of borrowing. This, in a way, enabled the government to issue more debt as the cost of servicing the debt was low. However, when COVID hit and the unprecedented stimulus by the government, which you can see in the M2 chart, resulted in a big spike in inflation. The Fed now started raising rates, and the yield started to rise both due to rising inflation and also because of the Federal Reserve QE program. Currently, the average interest rate on the federal debt is about 3.2%. Now, let's see who holds the government bonds. In 1970, the percentage of U.S. debt held by foreigners was 5%, and it rose to 23% in 1995, mainly due to the petrodollar system initiated in 1970s, and now stands at 30% in 2022. The changing geopolitical landscape and the increasing use of economic sanctions and weaponizing the SWIFT system has resulted in China, which was once the biggest holder of U.S. government debt, to reduce its bond holding substantially over the last few years. In spite of this, the federal debt held by foreign and international investors have continued to increase from $3 trillion in 2010 to $8 trillion now. Off note, we see a substantial increase in UK holding of US treasuries. We will speculate on the reasons later in the video. The chart from the Peter G. Peterson Foundation provides an analysis of the percentage of domestically held U.S. debt owned by various domestic creditors as of March 2023. Federal Reserve System, 35%. The Federal Reserve holds the largest portion of domestically held U.S. debt, owning 35%. This reflects the Fed's significant role in purchasing government securities, particularly through programs like quantitative easing. Mutual funds, 15%. Depository institutions, which include banks and savings institutions, hold 10% of the debt. These institutions invest in government securities as part of their asset management strategies. State and local governments, 9%. Pension funds, 6%. Insurance companies, 2%. Other, 22%. Let's speculate on what might happen if interest rates increase significantly. Higher interest rates would lead to increased costs for servicing the debt, potentially forcing the government to either cut spending or increase taxes. This could slow down economic growth and reduce the government's ability to fund essential programs, and will also be very unpopular. So the easiest option that the US government will take is to devalue the dollar. By reducing the value of the dollar, the government can decrease the real value of its debt. This has been done before. In 1930s, the US government had confiscated all private gold at a fixed rate and then at a later time increased the price of gold, effectively devaluing the dollar. During the Great Depression, the United States faced severe economic challenges, including bank failures, massive unemployment, and deflation. We predict a similar event coming soon. In response, President Franklin D. Roosevelt took unprecedented measures to stabilize the economy and restore confidence in the financial system. Confiscation of gold. Executive Order 6102. On April 5, 1933, President Roosevelt signed Executive Order 6102, which required American citizens to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for $20.67 per ounce. This order effectively outlawed the private ownership of gold, with certain exceptions for jewelry and collectors' coins. Purpose. The goal was to prevent hoarding and to increase the money supply. By confiscating gold, the government aimed to take control of the currency supply and use it to combat deflation. Impact on the public. Citizens were required to exchange their gold holdings for paper currency. Noncompliance could result in significant fines and imprisonment. Gold Reserve Act of 1934. This act, signed into law on January 30, 1934, authorized the federal government to take ownership of all gold and gold certificates held by the Federal Reserve. It also prohibited further private ownership of gold except under government license. The Gold Reserve Act established the Exchange Stabilization Fund, which allowed the U.S. Treasury to control the value of the dollar on the international market. Following the confiscation of gold, Roosevelt aimed to devalue the dollar to stimulate economic growth and reduce the burden of debt. Revaluation of gold. In January 1934, the price of gold was raised from $20.67 per ounce to $35 per ounce. This 69% increase effectively devalued the dollar, as the currency was now worth less in terms of gold. The devaluation helped to increase the money supply, reduce real interest rates, and stimulate exports by making American goods cheaper for foreign buyers. Currently, there is no effort by the Congress to address the issue of the rising debt. But eventually they will be forced to act, as the market forces will eventually force their hand. As we can see, the US dollar index is linked to a basket of currencies which are all weak. The only way to devalue the dollar is to devalue it against gold or against a basket of commodities. I think whichever they choose to devalue the dollar, the other currencies will continue to fall against the dollar. We are already witnessing this. Have a look at these charts. Gold versus US dollar, gold versus GBP, and gold versus Japanese yen. One of the worrying things for us is the geopolitical fragmentation between the East and West. The rapid economic growth of China and the BRICS, with their economies eclipsing the G7, has resulted in the BRICS and Global South increasingly willing to challenge the dollar hegemony. Europe will be the biggest loser in this geopolitical fragmentation, as their energy costs are very high and their population is aging, and they are controlled by the EU elites who cannot take a coherent geopolitical strategy. So here at Mafed Investments, we predict a sovereign debt crisis starting in Europe. This will lead to money flowing into the dollar from Europe and lead to the dollar going up at the same time as gold. This will be like the sea receding just before a tsunami wave. Once the money floods the US dollar, the dollar will be devalued. We have taken some assumptions here, and this is just one possible scenario. We now have to think about how to protect our wealth from destruction. Here are several ways the US government could potentially devalue the dollar. Monetary policy adjustments. Lowering interest rates. By reducing interest rates, the Federal Reserve makes borrowing cheaper, which can increase spending and investment. Lower interest rates also tend to weaken the dollar because they make U.S. assets less attractive to foreign investors. Quantitative easing. QE. This involves the Federal Reserve buying financial assets, such as government bonds, to increase the money supply and lower long-term interest rates, leading to a weaker dollar. Fiscal policy adjustments. Increased government spending. By significantly increasing government spending without corresponding tax increases, the government can increase the money supply, potentially leading to inflation and a weaker dollar. Tax cuts. Reducing taxes without reducing spending can increase the deficit and the money supply, contributing to dollar devaluation. Inflation. Allowing higher inflation. The Federal Reserve could tolerate higher inflation levels, which would erode the value of the dollar over time. This approach can be risky as it may lead to uncontrolled inflation. All the above strategies are part of financial repression, which aims to reduce the debt burden over a period of time by keeping the real interest rates below inflation. In conclusion, the U.S. debt crisis is escalating, and we need to keep a close eye on how things play out for the U.S. and European economies. We also have to keep an eye on the evolving geopolitical situation. Diversifying some of the wealth into different sectors and different low-debt economies is one way of protecting your wealth. Swiss franc is one currency that might benefit. So will gold. One of the things we would advise you to watch for is the central bank balance sheet. Currently, all of them are trying to do QE to control inflation. However, when they start to rise again, then we know that there are no buyers of the sovereign debt. That is the first indication that things are not going well. Warren Buffett recently said that he would not want to hold long-term government bonds at current levels. The reason being, you won't be able to sell any of your bonds when the devaluation happens. Thank you for watching. Don't forget to like, subscribe, and hit the bell icon for more in-depth analyses of important economic issues. Leave your thoughts in the comments below. How do you think the U.S. should address its debt situation? We'd love to hear your opinions.